Mr. Puri, such a pleasure chatting with you. I want to start talking about the macro picture and then get down to HDFC Bank. It's been, what, 15 months since this government has been in office, and there was this euphoria in corporate India when the government took charge. Gradually, that made for cautious optimism, as some would like to call it. And then now one can sense a bit of restlessness creeping in corporate India on the pace of reforms. Everyone's asking, where are the Chedin?
No, I think that's a bit unfair. If you look at it, if we go back in time, I think the expectations from the Modi government were too much to begin with, and then we came to a sensible level of expectation because there's a lot of baggage that was carried over to them that they had to solve. Our own view is, I think the changes have been positive. Could they have been a little faster? This is the real world. A lot of the changes got stymied for no faults of theirs, but still a lot has happened. And between good faith and the actions that they've taken, I think we've come a long way. I think the expectation that private investment will come in such a hurry was probably misplaced. Private investment follows GDP growth. But I do believe that overall, talking to the foreign institutional investors, the perception of India being an emerging market, which is an exception in the whole world and with good prospects, is something that is a good achievement. And so I am not on the pessimist side.
Okay, you're not on the pessimist side. But let's talk about some of the specific issues which is concerning some of the foreign investors. GST, which was billed, is this big game changer. Given the political mandate, the expectation was that it will go through sooner than later. Deadline of April 1, 2016 was set, and now we're given to understand that special session of Parliament is not being convened, which essentially means that deadline is a huge question mark. So we're looking at a delay by 1 year on what was probably the most important reform as far as taxation is concerned. How big a dampener is this legislative logjam?
Obviously, it's a dampener, and without getting into the politics of it, I just wish everybody got together and what was important for the country gets through. You can have your differences, but if something is genuinely important, it's best if we sit down and get it through. So is it a dampener? Yes. Is it a dampener that substantially affects our growth prospects? No. So would they have been higher if GST had come through much faster? And I still hope that it does come through in a reasonable period of time. Yes. Is it a problem in terms of our 7.5% to 8% growth rate? I think no. Is it the fault of the government? I don't think so.
So you don't think GST, if it doesn't happen on April 1, 2016, will hurt our growth prospects in the medium term, or that it will significantly damage sentiment?
No, that's not what I said. What I'm saying is that GST would lead to a higher growth, which is good, which would be good for the country.
Sure.
Is it something that should have happened? I think so. The fact that it has not happened, whereas it affects the rate of growth, it could have been 8% plus much faster, but that 7.5 to 8 doesn't get affected.
Okay, let's talk about the land bill, because that was again seen as a bold reform that the government took soon after it came, it took power, issued an ordinance that was seen as far more pro-industry, because land clearances was a huge bottleneck because of which large projects weren't taking off. Now the sense that one gets is that the government has kind of gone back on the land bill because it's realized that the narrative changed to being anti-poor, and so therefore because of political considerations it had to go back on the land bill that was, or on the land acquisition norms that it had proposed. Again, a big setback, would you say, or no?
See, without getting into the politics of things, two things have to be clear. We had an election, and that election was won by a government based on a development and growth path. There were enough people who were wanting to win the election on the basis of, we've got to give the poor and we've got to increase our deficit, etc. So a realization along those lines would be good. The land bill coming through, I think, is an important issue, but the little that I know, and I must say I'm not an expert, is that now, since it's a concurrent subject, in any case the land bills would have to be sorted out by the state. And so I think that's the route that they're going to take. And we are moving to competitive federalism. And so that would probably be less of an issue than GST, which is a constitutional amendment, and there's no way around it. I think the land bill being a concurrent subject and the states being keen to get industry in, every day you get, now we've got vibrant, used to have vibrant Gujarat, now you have vibrant Tamil Nadu, you have vibrant Bengal, you have vibrant Rajasthan. So I think for their own benefits, the state will come around and sort the land issues out.
Right, so you're saying the pace of reforms hasn't disappointed you. If that's the case, then why hasn't the investment cycle turned? I know it will take some time, but 15 months is enough time, one would imagine, for some investments to break ground. Why hasn't that happened?
See, we have to understand two things. That investments will come when there is a clear uptick in GDP and demand exceeds supply, or there is a projection, a firm projection of demand exceeding supply.
Sure.
So we have said from the beginning that investments will only come when the GDP picks up. Now the GDP has already started to pick up. We do believe that it will be somewhere in the 7.5 to 7.6 range now. And it will need to be preceded by government expenditure, which is happening. And once the GDP starts ticking along, private investment will follow. The object of businessmen is to do business, and when they see opportunity, they will. It's not going to come from the media asking. It's not going to come from the FII asking. It's going to come from the reality on the ground.
But even the Prime Minister is asking in a meeting with India, and he did say, why aren't you taking more risk? Almost urging corporate India to take risks and invest. So one can sense even the government is a little puzzled as to why investments aren't happening.
The government, I also read in the newspapers what came, and probably what he's saying is that if you believe in the future of India, take a bit of a bet, and some will, some won't.
So when do you think will people start taking this bet?
I think it's at least a year away.
At least a year away before the investment cycle turns.
Yeah, no, before not the investment cycle turn, before investments become reality and start affecting GDP. That's why in our own growth forecast, we're saying 15-16 is going to be somewhere in the 7.4 to 7.6 range, and 8% plus will only happen in the 16-17 as a combination of increased consumption plus increased investment. So the delta from private investment will follow public investment, and the public investment has started to come in. So we think that the 8% growth rate, which necessarily needs private investment, will only be a subject next year.
Sure. One of the reasons, or what corporates tell us a lot, is one of the reasons why investments aren't happening is because of the interest rate regime, and that the RBI hasn't really cut rates. And you speak on the day of that meeting, every CEO we spoke to, attended the meeting, walked out and said, interest rates, interest rates, interest rates. Yeah. What's your sense? Is it, is too much being made out of the interest rate
Absolutely.
regime?
Anybody try. Let's look at facts. I mean, you can walk out and say, is interest rate, a drop in interest rates, is it going to cause the economy to boom all of a sudden? I don't think so. Interest rates, except for the highly captive intensive industry, constitute only 4% of sales, maybe 4 to 6. So that cannot be the only criteria. The steel prices with the dumping of steel are 25% lower. Would they want to lower their price on automobiles and some of their projects? That could, actually kickstart the economy. So is interest a component? Yes, but there are a lot of other components which are also necessary. So monetary policy cannot be the kickstarter of industry revival. That has to come from investment, that has to come from creation of demand. And so is it important? And interest rates have been dropped. I mean, they're crying. Most people are borrowing from the CP market today at around 8%. So from 11 to 8 is a hell of a journey. Base rate, at least for our own, has come down by almost 1%. So will interest rates come down? Yes. Is it a component that would help in the growth? Yes. Is it the only component? No. Do I expect interest rate to go down? Yes.
By how much? Through the course of this financial year?
I think just the demand and supply, and I'm not talking about RBI policy now, lest you think that I'm second guessing or advising. I'm not talking about RBI policy. I believe, based on the fact that the liquidity that's come in consequent to government spending, based on the slack demand that is there, I think before the year end, between another 40 to 50, maybe 60 basis points will come anyway, with or without RBI action.
And if there is RBI action, because everybody expects some amount of RBI action as well. People are talking.
It would be somewhere between 30 and 50 basis points.
That's the RBI.
I'm talking from my point of view. So if you talk from the market's point of view, it could be 60, 70 basis points.
But what about the scope for a rate cut from the central bank as well? People are talking of an out-of-turn rate cut as well. Of course, the policy is due later this month.
See, this also, again, I mean, it seems to be very topical for everybody to be discussing this. It is amply clear that what is required and what can be done. So if you look at from the RBI's point of view, he is concerned that inflation, which could in the long run, which has been licked and would probably lead to good long-term growth, whether there are downside risks to inflation picking up. With a drop in the commodity prices, with actual better food supply management, the likelihood of inflation picking up on the other side is a little less. Now, you can...
The government is talking of deflation.
So you can go this way also, you can go that way also.
But the government is talking of deflation. Chief economic advisor saying the problem now is deflation and not inflation.
So that's why I give you two viewpoints. No, this way also can, that way also can. Wait and see. But interest rates will go down either way.
Sure. Let's talk about the global environment, because Mr. Puri, that's something that we have very little control over. I know many in New Delhi believe that the mayhem in China presents a great opportunity for India to emerge as a global growth engine. You were candid a few weeks back when you said that China's move to devalue the currency is a very dangerous move that it's doing. What's your sense on the opportunity that this presents for a country like India? Can we really be decoupled?
Let me give you my own views.
Sure.
I think when you talk about the Fed interest rate, because that's one part that's coming in. When we talk about Fed interest rate, which is the most heralded marriage ever, I mean, it's there forever, and if you think markets haven't built it in, we must be in cuckoo land. But obviously, there's a flip side. Interest rates normally go up either because of a financial shock, when they can be bad, or they go up like they're expected to in the US because the economy has picked up. If the economy picks up, yes, there could be some increase in interest rates for people who have borrowed in dollars, but if the largest economy starts to grow faster, there's also scope for us to grow on the GDP side through exports. If you go through history, whenever the yields have gone up and they are not based on a shock, then always emerging markets, after things settle down, get a larger flow because the risk perception changes. So I think everybody is focused on the downside, but there's an upside also, because the interest rate is only going to come up when it reaches a 2% inflation, 5.6 or 5.7 job growth, and GDP growth rate of about 2.5 to 3%, which I think is good and bad news. Coming to China, I think it's overplayed. The equity market in China is very small. They have very large reserves. The property market is coming around. If you look at what Stephen Roche, the good friend from Morgan Stanley, said, they have actually moved a lot to a consumption economy from an investment-led economy. So as the commodity cycle turned, yes, which is good for India. Have they moved towards 48% consumption-driven, and their future economy is going to be more services-led, and they will probably not be a major engine for growth, but I don't think there's a crisis coming in China. So net-net, if you see globally, it's not a bad time for India.
But this is a time when, for example, today Brazil's been has been downgraded to junk status. So there is going to be some amount of pain around the world. How decoupled are we from all this global?
It's not a question of decoupling. You shouldn't compare an apple and an orange. Brazil is a country that booms when you have a booming commodity cycle. Brazil is a country that has a current account problem. It has an interest rate problem. So without flagging India, and as you always said pre-interview, I'm an optimist, so let me give you my optimistic view. We don't have a current account problem. In fact, it's excellent. We don't have an excess borrowing problem. Our fiscal deficit is doing well. We are not a major export, and that's where they talk about there is an opportunity. If China is going to be more focused on their domestic consumption base, there is an opportunity for us to export. So, and if we grow at 7%, that will be one of the highest growth rates. So I think Brazil, I feel sorry for them. India, I'm happy for.
So you think India can be a global engine of growth, or are we still a fair distance away from getting there?
A bit of both. We can be an engine, but don't expect it tomorrow, and let the government function.
Let's talk about the other key area of concern back here, which is the whole infrastructure projects getting stuck, and there's been very little headway as far as that issue is concerned. You, for instance, are not so optimistic on the fact that some of these loans will indeed turn around and that some of these projects will take off. The government is concerned about this as well. How do you get these projects off the ground? Because that's one of the key areas of concern. What's your sense? What's the way forward as far as these stuck infrastructure projects are concerned?
See, there again, I think it's not that all projects are stuck. Have we solved the issue on coal? Yes. Are we seeing people who are unable to get the projects through or have too much debt selling their projects? You just saw JSW buy from JP, you're seeing SR selling, you're seeing the others selling without going into too much, but there is a reorganization that's happening. Are some projects still stuck? Yes, so you will have to divide all the projects, which I do believe that the government is in discussion with the banks. We unfortunately or fortunately actually are not exposed too much to them, where you will have to divide these projects into projects that can be viable as they are, because they were good promoters, etc. They are projects that for whose viability both the promoters and the banks will have to take a haircut and new money will have to be infused. So I think progress is being made. Probably a little slow because there's a hell of a lot involved, and there's central government involved, there's state governments involved, there's regulatory bodies involved. So is the progress as fast as expected? No. Has there been some good progress? Yes. So for instance, if the coal is sorted out, a lot of the electricity generation is sorted out, but the discoms are not buying at the price that electricity is to be manufactured. But on the other hand, the consumers are using diesel, where it comes to almost 10 rupees a unit, and so 4 or 5 is a steal. But so that's the issue between the center and the states and the discoms, and the moment I believe that is under active consideration. And the moment that's sorted out, I think you'll see a lot more projects come through.
Sure. Let's shift focus and talk about HDFC Bank. In many ways, you're now
finally
you're now the toast of the market, and not necessarily because you've got a host of accolades, best brands, and whatnot, but a host
best bank in Asia also.
Sure, but a whole host of brokerages have also now turned bullish on the stock. Given the whole environment, and there are reasons which I will come to. But I want to first talk about what has really changed fundamentally for the bank in your view, that's turned the market a lot more optimistic on your bank.
See, first let's look at where we are positioned and where the country is going. As far as we are concerned today, we have, as you rightly said, the most valuable brand in the country. We are among the top 100 brands globally. We have a very strong balance sheet with capital adequacy beyond 16%. We don't have any strain on our portfolio. Our net NPAs are 0.1%. And there are 2 or 3 good things that we did. We are a major player in semi-urban and rural India. Over the last 3 years, we've gone in there, and we have almost 55% of our distribution in semi-urban and rural India. That is virgin territory because the penetration of organized finance is just 8%. So there our business is growing phenomenally. It was a lot of hard work. I mean, questions that people have been asking me, why haven't the other gone in? It's a lot of hard work. The ticket size is smaller, your costs are higher, you have to work out the operating model, which we have done with a lot of art. The second is the digital initiative. Now everybody talks digital, so let me give you an understanding of what our digital initiative is. When the institutional investors were talking to me about the disruption in financial services, they were talking about people who were going to come in and change the way people make payments. People purchase under e-commerce, people give loans, net worth management, selling of insurance, selling of mutual funds, etc., stock. So I went to Frisco and looked at it, and all of them were talking about using the network over the top of the bank system. We came back, sat down here and looked at it. We are market leaders in personal loans, two-wheelers, car loans, credit cards, merchant acquisition. 50% of the payment gateways on the e-commerce sites are ours. And we've had data warehouse and analytics as well as a customer-centric model for a long time. So we sat back and said, can we also use the network like these disruptors are using to create an experience for the customer which fundamentally alters the way he handles his financial life in a far more convenient manner. So we took each of these areas and said we are in 5 or 6 businesses. We are in the loan business, we are in the payment business, we are in the advisory business, we are in the access business to e-commerce and purchase decisions, and we are in the cash management and trade business. So first we looked at loans, and we completely altered our processes as well as used the network to create a situation where you can get a personal loan in 10 seconds. You can get a car loan in 10 seconds if you are our customer. If you're not our customer, 30 minutes. You can get an instant card. You can get a loan against shares in 10 seconds.
And as a result, 88% of your transactions are now on non-traditional platforms, so to say?
See, no, one is non-traditional platform. I'm saying we fundamentally altered banking. So look at the convenience if you can do this. The second part was, we said we must intermediate in the shopping experience.
So help me understand, in terms of what it does to the consumer is pretty evident.
Right.
What does it does for you financially in terms of changing the dynamic of your bank?
Financially, that was one of the things I was talking yesterday at the brand conference. 2 things it does. One, clearly in the customer's mind, it positions us in terms of salience. You agree with that? That anything you want to do, you think money, you can do it with HDFC Bank much faster and far more convenient. Secondly, it improves customer service because you are doing it yourself, and it's straight through. Thirdly, it reduces my cost. Fourthly, it changes my access in terms of geography. So for instance, loan against shares I can offer anywhere in the country now with only processing here.
So stepping back, how do you see fundamentally will the dynamic of the banking sector change on account of such a disruption? Do you think 5 years from now we'll cease to have this many branches? How do you see the banking sector change?
3-4 things will change. I was reading David Ogilvy's book, and what it said is the customer is not a moron, she's your wife. For those of us who are married, have to understand that the wife also changes with age, and you better adjust if you want your marriage to continue. So the banking system will change in line with consumer demand. So what will happen is there's a semi-urban and rural customer, there's affluence there also, there's an urban customer, there's an old man, there's a young man. So do I feel that in 5 years a much larger proportion will be digital? Yes. Will the branches completely disappear? No, because we're largely a cash economy. Almost 80% is cash. So probably the cash component will come down to 40%. So what we are offering is you can come in to any channel. So you can use the phone, you can use the iPad, you can use your desktop, you can come into the branch, you will get the same service delivery. So cost dynamics will change. The range of what is described as banking will change. The convenience to the customer will change. Brand management will become different. The marketing will become, you will have to have personalized marketing. Mass marketing will die. What else do you want to know?
That's a fair bit of change over 5 years. Just a quick set of few questions before we wrap this interview, which the standard one, something that the market is worried about, or not worried about, is interested
You're not going to ask about merger again.
No, okay, sure. Since you've said, I'll ask you about the merger as well. That's a standard. That's a standard question that has to be asked.
Standard question when it makes sense.
Yeah, so
we do believe.
Is it on the table?
No, it's not on the table. We do believe that in the long run, a merger is beneficial for the group.
What will be the trigger for it?
The trigger is, so let me finish. We do believe that the merger is beneficial for the group. However, there are some issues in terms of different regulations for banks and housing finance companies, which create a problem in the valuation. We are in discussion with the regulator, and as and when there is any change which results in the fundamental fact that the merger becomes beneficial for all concerned, it could happen very quickly. If there is no change, it may not happen.
Okay. Any plans to unlock value from HDB Financial Services and HTFC Securities? Because now these businesses are also reaching a certain amount of inflection point. So, any plans to unlock value there?
No, we've got more than enough capital. We'll unlock value. We're greedy people. We'll unlock value at a little high price.
Okay. So, which could be 2-3 years away from now?
Possible.
Okay, and obviously since you are well funded now, you have more than enough capital, so I'm guessing no fundraising plans in the near term at least?
No.
None at all?
None at all.
Mr. Puri, such a pleasure chatting with you. Thank you for being candid as always. Thank you so much.
Thank you.
Thank you.